Morning, everybody. It's Wednesday, October 15th, 5:24 a.m. Central Time. Grain market's just a little bit lower this morning. December corn futures down 1.25 at 4.11 3/4. November soybeans down 3 at 10.03 1/2. December Chicago wheat down 1.5 cents at 4.98 3/4. December Kansas City wheat down 2 at 4.86 1/2. December spring wheat down 1.5 at 5.52. Trump was truth socialing again yesterday. Why don't we start there?
So, Trump is considering a cooking oil embargo against China in response to Beijing's refusal to purchase U.S. soybeans. He characterized China's absence from the U.S. soybean market as an economically hostile act that is hurting American farmers. Back in 2024, Chinese used cooking oil exports reached a record high, with the U.S. importing roughly 1.3 million metric tons, accounting for 43% of all exports. Trump, however, believes that the U.S. is capable of producing its own cooking oil, which would reduce the nation's reliance on Chinese imports.
Let's go to the Truth Social post. Donald Trump posted this yesterday afternoon. I believe that China purposefully not buying our soybeans and causing difficulty for our soybean farmers is an economically hostile act. We are considering terminating business with China having to do with cooking oil and other elements of trade as retribution. As an example, we can easily produce cooking oil ourselves. We don't need to purchase it from China. The markets, and not really the grain markets, like the outside markets, the stock market, like went crazy on this thing and sold off because they see it as an escalation in the trade war. I'll tell you this threat is silly and misguided. I'm not sure that the president totally understands exactly what it is that he's talking about here. There was a point several months ago, and Mackenzie, you remember reporting on the used cooking oil stuff.
Mm-hmm.
There was a point in which we were running stories about used cooking oil from China, like on a weekly basis. And the story is this: the U.S., as it relates to biofuel production, had been subsidizing biofuels made with imported Chinese used cooking oil. And the farm lobbies really pushed back on it because they said, hey, wait a minute, why are we not using, domestically produced soybean oil for this sort of thing? The laws have changed, and the United States is no longer subsidizing Chinese imported used cooking oil for biofuel production. So that ship has kind of sailed. This is an issue that we're not really dealing with. This is a great chart from my friend Garrett Toy on X yesterday. U.S. soybean exports to China versus used cooking oil imports from China in thousands of dollars. You can see the value of imported used cooking oil from China is very, very tiny compared to the soybeans that we export to China or did export to China. So I don't think China's going to care about this at all, really. Now, if you're talking about the oils that people actually cook with, things like vegetable oils, olive oil, those things, if they're imported at all, they don't come from China. They come from non-China destinations. So I feel like this is kind of an empty and silly threat, and it got the markets riled up, but China's not going to care about this. It's just that used cooking oil story. It's old news. It's over and done with. We're not subsidizing that stuff anymore, and we shouldn't have been to begin with, but we're not doing it anymore.
Soybean futures were marginally lower on Tuesday amid strong export inspections. For the week ending October 9th, shipments totaled 994,000 metric tons, the highest level since February. Top destinations for the week included Mexico, Spain, and Bangladesh. Persistent U.S.-China trade tensions continue to pressure futures. Additionally, the ongoing government shutdown has delayed the release of key USDA data, making traders more cautious to take big positions in the market.
We'll talk about export inspections in a little bit more detail here in a second. I figured I would take this opportunity to show you a monthly soybean chart and talk about price action. The market has been incredibly dull since August of last year. We ran a story a couple weeks ago about how mainstream media had been discussing the soybean and tariff situation just everywhere. Like every mainstream media outlet had some sort of article. And given the press that this story has seen, you would think that the soybean market's dropped like 50% this year. Like you've seen some massive collapse. That's not what we've seen at all. This market has been dull as hell for more than a year. We haven't done anything. We've been confined to a range of really like $1 per bushel, generally speaking. Since August of 2024, it's been like $1.40 per bushel, which is very, very small. The last time we had really high soybean prices was in 2022. That was the result of a number of things. We had the phase one U.S.-China trade deal. China came in and bought a bunch of beans. We had kind of an inflation commodity rally where all the commodities rallied because we had inflation. We had Russia-Ukraine, which really was more of a wheat market thing, but also helped to rally soybeans and a lot of other stuff. We were very cheap from 2014 really through the middle part of 2020. the U.S.-China trade war, the first one happened in 2018 and 2019 and resulted in some pretty low prices. China was also dealing with African swine fever at that time, and they really didn't need the soybeans from the United States. They could afford to fight the trade war. But that whole period from 14 through the middle part of 20 was just, it was oversupply. It was generally non-threatening weather or good weather. And then you had your big 2012 U.S. drought blow up. So the market action in soybeans has been very muted and really not very exciting at all, which is contrary again to what the headlines would maybe lead you to believe.
So as I just mentioned, U.S. soybean shipments were strong last week. They were near the upper end of pre-report expectations, coming in at 37 million bushels. The print was up 27% compared to the prior week, but down 48% versus the same week last year. Corn shipments fell below expectations at 44 million bushels. The print was down 34% compared to the previous week, but up a whopping 120% versus the same week last year. Wheat shipments were near the lower end of expectations at 16 million bushels. The print was down 19% versus the previous week, but up 17% versus the same week last year.
We'll start with corn. That shipment number was down sharply on the week. Still, I was looking at some data. That is the best seasonal corn shipment for this particular week of the year in at least 10 years. So the soybean, or the corn shipment program rather, is very, very strong. The soybean shipment number was good relative to last week, and we're seeing our normal seasonal increase in soybean shipments on a weekly basis. It's just that shipments are muted because export sales are muted and we're not shipping anything to China. So despite the fact that we've been higher the last couple of weeks, we're not where we really should be or would be without the trade war. And this is where you're seeing the trade war reflected in supply and demand, is in sales and shipments. And we don't have the sales. We've got, I think, because we haven't seen USDA reports, we haven't seen the export sales report in a couple of weeks, but we've probably got the worst book of soybean export sales in at least 10 years. And the last time we had a print below what we saw this most recent week was in 2019. And that was, of course, during the last U.S.-China trade war.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about some of our recent premium videos?
Shay was on with Vance Crowe yesterday, and they had a detailed discussion on negotiating with landlords, basically cash rent and that sort of thing. And this was kind of eye-opening for me because that's not really my forte. I don't specialize in landlord negotiation, but Shay's a farmer and Vance has a lot of experience in this topic. And I think that there was some stuff that was pretty eye-opening for me, at least. We had some really positive feedback on this one. Josh Linville was on Monday. We talked about fertilizer prices and geopolitics. Super interesting stuff. If you don't understand the geopolitical landscape of the fertilizer market, I think that you should. It's pretty important. Brian is going to be on with Mackenzie doing charts today. That stuff is always fantastic. If you want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody will try to sell you anything else. Nobody will call you. Nobody will bother you. I don't want to talk to you on the phone. I don't even make my phone number available. We don't want to do your brokerage business. We don't want to sell you crop insurance. We just want to send you our emails with all of our videos and stuff every single business day. I know you guys are busy. You're in the combine, you're in the truck, whatever. Everything that we send out is easily accessible on your phone through just one click in the emails. No login instructions, no messy stuff like that. Check that deal out this morning, guys.
President Trump's new U.S. port fees are adding financial pressure on Chinese shipping companies. The policy, which took effect on Tuesday, aims to restructure global trade by targeting Chinese-built and Chinese-owned vessels. Major Chinese carriers such as Costco Shipping and Orient Overseas are expected to face substantial fees next year, while non-Chinese shipping companies can largely avoid the cost by operating non-Chinese built ships. In response, China last week imposed special fees on certain U.S. vessels. Last month, Chinese exports increased 8.3%, but shipments to the U.S. fell by 27%.
Okay, so as it relates to grain exports out of the U.S., it's been made clear because of some lobbying from the farm groups that a lot of the bulk carriers, like your Panamax vessels, they're going to be exempt from these fees. So if you're a bulk carrier and you're carrying corn or soybeans or whatever, you're probably going to be exempt from the fees. A lot of other items, I think people are talking about crude oil in particular, or oil shipments, could be at risk of facing higher shipping costs. And the kind of threat back from China is maybe the newer part of this. The American Farm Bureau Federation had some really good charts about this that we threw in the email this morning. Excellent stuff. Deadweight tonnage capacity of U.S. built ships by year of construction. We're not really doing much here in the United States as of late. Here's share of shipping equipment produced in China, China produces a lot of shipping equipment, and here's China's share of annual global shipyard output, more than half, 53%, the last couple of years. So I think that this will increase costs on some items, and just like the tariffs, a lot of this stuff is going to be passed on to the consumer in the U.S. and elsewhere. Ultimately, I don't really like any of this stuff personally, but we'll see what happens.
CONAB is forecasting a record Brazilian soybean crop this season. The agency estimates the crop at 177.6 million metric tons, largely unchanged from its September forecast, but roughly 3.5% larger than last season. Soybean exports are projected to reach 112.1 million metric tons, up 5.1% from last season. The agency pegged this season's total corn production at 138.6 million metric tons, also mostly unchanged from last month and 1.8% below last season. Exports are slated to rise to 46.5 million metric tons, up 16% versus last season.
Looks like big crops are on the way. It's very early. There could be a weather problem, of course. We're very, very early into the season. But USDA is projecting a record Brazilian soybean crop. The forthcoming Brazilian crop is expected to be 50% larger than this year's U.S. crop. And it was just, 6 years ago that we were about the same in terms of soybean production. So Brazil continues to expand while the U.S. is basically flatlined. And this has a lot to do with the woes of our export program. It's not only do we have a trade war with China, but also Brazil is just producing a ton of soybeans, and they can continue to expand on an annual basis. What did cattle do yesterday?
Cattle futures had another impressive day. Live cattle were $1.25 to $2.10 higher. Feeders saw gains ranging from $3.95 up to $4.67. Box beef prices were also higher. Choice was up 51 cents at $3.64.42, and Select was up 80 cents at $3.50.55.
Dow Jones is up 180 points. The S&P is up 38. Treasury's up just a little bit. U.S. dollars off. Crude oil is flat at 58.70 in the November WTI. Have a great day, guys. We'll be back on Thursday.